Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's just after 7 a.m. Mountain Time on Monday morning, September 8th. Our note this week was titled Get On With It. It's a little bit of an abbreviated version of Governor Waller's speech from about 10 days or so ago titled Let's Get On With It. It's time for the Fed to ease. As we've been saying, we're in the 50 basis point camp for their first cut in the resumption of their policy rate normalization process. The way we get to 50 from the current expectations of a little better than 25, a small percentage of a 50, is we get a large first estimate of the annual benchmark revision tomorrow morning. And then on Thursday, we get a fairly benign CPI report. Before we get started, I wanted to make a quick comment about Ken Griffin's op-ed in the Wall Street Journal today, lamenting the threats to Fed independence. This is a tempest in a teapot in our view. We wrote about it. There's no evidence in the bond market of any risk premium associated with Fed independence. But the real issue here that Ken gets wrong, and albeit for us to call this brilliant trader and market maker wrong about macro issues, but I'm going to do it anyway. A better approach to this is something that an essay that came out yesterday afternoon by the grumpy economist John Cochrane from the Hoover Institute in Stanford, titled Monetary Fiscal Interactions. And the bottom line here is we've all been brainwashed, at least over the last 4 decades or so that I've been in the markets and studied economics and got my MBA and all that other stuff, to believe that that inflation is always and everywhere only a monetary policy phenomenon. That's just not the history of the U.S. The inflation we got after World War II was caused by fiscal spending. Could monetary policy have theoretically soaked up the additional demand? Theoretically, yes. Politically, no. Same thing in the 70s. And same thing in the 2020s. It was excessive fiscal policy. Could monetary policy theoretically have offset it? Theoretically. Politically, no way. And that is the bottom line. So all this focus on President Trump beating up on the Fed to cut rates misses the more important point, which is to really restrain inflation over the long run. We need to get government spending back to 20% of GDP. Receipts have averaged 17 since World War II, with a very small standard deviation by administration. The only way we get spending or inflation under control in the long run is by cutting spending. So let's move on from that point. There's just a wall of evidence that the labor market is weak and has been weak for quite some time, for the better part of 3 years, primarily attributable to the way the Fed eased using their balance sheet and tightened using rate policy. This put all the burden of tightening on small banks, small businesses, floating rate borrowers, a constant theme of our work for the last 3 years, that chickens are coming home to roost. The Fed describing the labor market as solid because the unemployment rate has been stable is really dubious. First of all, we think it's being understated, as evidenced by the Conference Board labor differential that suggests the unemployment rate's more like 4.5, and the underemployment rate is really probably closer to 8.4. But even with that, the unemployment rate has moved up from 4 to 4.3. The underemployment rate has moved up from 7.5 to 8.1 this year. So we're getting close to another trigger of the SOM rule. The labor market is decidedly weak and inflation is essentially stable. We get those numbers this week. We've made our case that fiscal policy, the rate of change, although we're still spending too much, that rate of change has come back down to its long-term median. Money supply growth has slowed. The conditions are not in place for sustainable inflation. We'll have more to say about the actual inflation numbers next week, but the conditions are not in place for a sustainable increase in the rate of inflation. Moving on, we've also had a rapid rebuild of system liquidity, the Treasury general account, a lot of bill sales. We've actually had, of that $400 billion build, about $200 billion have come out of the Fed's RRP program. That has no impact on private sector liquidity, but $200 billion has now come out of bank reserves. We still think those bank reserves are excessive, but the things to watch going forward is, does the Fed decide to end QT? And if they did, and we think they probably will in the fourth quarter, not this meeting. And if they do, will they then decide to go to what they've been calling asset liability matching, which would imply that as mortgage backed securities get prepaid and as Treasury notes mature, they reinvest in bills? That, all things equal, would put upward pressure on the back end of the Treasury market. It needs to be done in coordination with Treasury and Treasury issuance. But this is a very clumsy Fed that really doesn't understand capital markets in its current construct. So those are the things to watch. Those are the sorts of things that could cause reverberations out through the capital markets. So we've made some significant changes to our asset allocation to lean into Fed easing. We think they desperately need to cut 100 basis points. We do think it will have impact on the economy. It will take a lot of pressure off small businesses. It will reopen the small business credit channel, get money flowing to builders, tighten the spread of mortgages to treasuries, restart housing activity. This is different than a year ago when they disinverted the curve or took away that big negative spread. This would actually be steepening the curve and create a powerful incentive to lend and for real estate developers to build. So this is a different story. We made some asset allocation changes to our equity holdings, our recommendations, and our fixed income holdings. To see those, become a paid subscriber. Barry Knapp from Ironsides. Have a good week, everyone. Thank you.